Coca-Cola, KDP, and Pepsi recently announced earnings for the second quarter of 2023. Coca-Cola is down 3% over the last year, PepsiCo is up 3%, and KDP is down 12%. And in this video, I'm going to analyze each of these highly competitive stocks that are all competing in the same industry, mainly the soft drink and beverage industry and snack industry. And I'm going to try to figure out which one of these companies is the best or which one is trading at the best buying opportunity relative to their intrinsic value per share. All of them are pretty much doing worse than the rest of the market, but we're going to see by looking into their financial statements if this decline in the share price is due to bad underlying financial growth or if it's actually an opportunity to buy the dip on companies that are actually growing year over year. So first and foremost, we can see there's an article right here about Coca-Cola that's titled, "Those who invested in Coca-Cola 5 years ago are up 54%, which if you think about it is really not that much considering that the S&P 500 is also up about 53%, not including dividends. So as we can see right here, they point out during 5 years of share price growth, Coca-Cola achieved compound earnings per share growth of 35% per year, which is growth that's higher than 6% average annual increase in the share price. Therefore, it seems the rest of the market has become relatively pessimistic about the company. They point out lastly right here, it's a quick article, that the total shareholder return is a lot different than the share price return. Although the share price return for Coca-Cola over the last 5 years is around 31%, if you include the dividends paid out to shareholders and you assume that those dividends are reinvested, the total shareholder return comes out to 54%. So basically, with dividends included, Coca-Cola is only keeping up on par with the rest of the market. So it's really not that good of a return, but we'll see if their competitors are doing a little bit better. We have an article right here about PepsiCo where they touch on an alarming news warning that came out about one of their artificial sweeteners called Aspartame, I guess that's how you would pronounce it. I'm not completely sure. But basically, there's a carcinogen warning from the WHO. And the primary source for exposure to this artificial sweetener is in diet soft drinks in the United States. And it was first approved as an artificial sweetener in 1974. But recently, the WHO said that it might be a little bit toxic. They said that it might be possibly carcinogenic to humans on July 14th for the first time by the International Agency for Research on Cancer and the WHO's Cancer Research Arm. Pepsi obviously has a pretty large stake in this artificial sweetener, as Diet Pepsi is one of the company's most popular global brands, and they use that sweetener in that drink. In 2021, Diet Pepsi brand's US market share came to 3.8%, but the CEO of Pepsi cited multiple studies on the artificial sweetener, concluding that it was safe as an ingredient, trying to stand up for or justify the utilization of this artificial sweetener in their drinks, saying that it's safe and that they can continue to use it in their beverages. So it could be a red flag for investors who are looking to invest into Pepsi if one of their main ingredients ends up being harmful to people and their customers, and they'll probably have to change up their product mix. So we'll see how that plays out in the future. But lastly, right here, we can see an article about Keurig Dr. Pepper where they recently bought a large stake in La Colombe, I think that's pronounced, for $300 million. The North American beverage giant, as we can see right here, KDP invested $300 million in Philadelphia-based coffee company La Colombe Coffee Roasters. And according to KDP, the $300 million investment represents a 33% stake in this new entity, and the cash investment will be used to pay off debt and also accelerate KDP's growth. So 3 quick articles, as we can see right here. For KDP, it's a quick little acquisition. For Pepsi, it's some harmful news coming out about their business and some of the artificial sweeteners that they use in their products. And then for Pepsi, touches on the return that they've returned to shareholders over the last few years, which hasn't really been that good because if you include dividends, it's only just keeping up with the rest of the market. So now I want us to look into the financial statements for these three companies. We can see for Coca-Cola, or actually we'll see for all of these companies that their financial statements actually showed pretty strong revenue and earnings growth for the second quarter. So we can see for Coca-Cola, revenue increased from 11.3 billion to 11.9 billion. So that's an increase of 6% year over year. And then for their net income, we can see that's an increase from 1.9 billion to 2.5 billion. That's an increase of 34% year over year for their bottom line earnings growth. And as we'll see, compared to the other companies, the 34% year over year earnings growth is actually the worst earnings growth out of the three companies. So that's definitely pretty good news for this industry. Then on page 11, we can see this balance sheet. Total assets came out to 98 billion, and they have total equity of 27 billion with reinvested earnings of about $72 billion. Obviously, they have a large treasury stock amount right here, which shows that they spend a lot of money repurchasing shares of common stock. Lastly, for cash flow statement for the first half of the year, we can see operating cash flow was 4.6 billion for Coca-Cola, and then they paid out dividends of $2 billion so far, and then they also purchased stock for treasury of $1 billion. So they basically used up almost all of their operating cash flow, about 66% of it, on returning value back to shareholders. So that's definitely a good sign for anybody who's invested in Coca-Cola. Now we can see Pepsi's financial statements. Year over year revenue increased from 20 billion to 22 billion. So that's an increase of 10.4%, which beats out Coca-Cola's 6% increase in revenue year over year. And then for net income, we can see it increased from 1.4 billion to 2.7 billion. That's up 92.3%. So that's obviously massive earnings growth. They basically almost tripled the earnings growth for Coca-Cola, who had 34% year over year earnings growth, and Pepsi's is 92.3% year over year earnings growth. So very impressive for Pepsi-Cola. Now we can see this cash flow statement for the first half of the year. We can see operating cash flow came out to 2 billion. And then if we scroll down here for financing activities, they paid out cash dividends of $3.1 billion and then also repurchased common shares of $450 million. So similar to Coca-Cola, they also returned a lot of value back to shareholders. They actually ended up returning more value back to shareholders than they produced in operating cash flow. So as a percentage of their operating cash flow, Pepsi actually returned a lot more back to their shareholders than Coca-Cola did. And then lastly, on page 8, we can see their balance sheet. Total assets come out to $95 billion, and total equity is $17 billion, with total liabilities sitting at $78 billion. And then Pepsi has retained earnings of $69 billion. Lastly, we're going to go to KDP's financial statements. We can see that revenue for KDP increased from 3.5 billion to 3.7 billion, up 6.6% year over year. So basically on par with the revenue growth for Coca-Cola. But as we can see from their net income, it increased from 218 million to 503 million, which is an increase of 130.7% year over year. So that's better than Pepsi's 92% and definitely better than Coca-Cola's 34% year over year earnings growth. So the winner out of these three companies for second quarter year over year earnings growth goes to KDP with their 130% year over year growth. Then on page 6, we can see their balance sheet. They have total assets of $51.8 billion, total liabilities of $26 billion, and total equity of $25 billion. And then they also have retained earnings of $3.9 billion. Lastly, for their cash flow statement, we can see for the first 6 months of the year, they had operating cash flow of $450 million. And then for their financing activities, they paid out dividends of $563 million and repurchased common stock of $457 million. So similar to Pepsi, they ended up returning more value back to shareholders than they produced in operating cash flow. Coca-Cola was the only company that produced more operating cash flow than they returned back to shareholders. So right here, we can see this discounted cash flow model to figure out the intrinsic value per share for these three companies. The first one is for Coca-Cola. They had 9% growth over the last 5 years. $6 billion of free cash flow in 2018, $9.5 billion in 2022. Comes out to 9% growth over the last 5 years, compounded annually. Weighted average cost of capital for Coca-Cola came out to 3.28%. We saw that 72% of their balance sheet was made up of debt, 28% of equity, and based on these metrics, including 2% interest rate on their debt, 18% effective tax rate, and 0.54 beta, their weighted average cost of capital came out to 3.28%. Year one free cash flow, which is our most recent full year, $9.53 billion. Net debt position of $27 billion and 4 billion shares outstanding, putting their intrinsic value per share at $48 per share, which means that at the current share price, they are definitely not trading below intrinsic value per share, as we can see right here, based on these metrics. Obviously, I encourage everyone to do your own due diligence, but based on these metrics, they're not trading below intrinsic value. Next, we can see Pepsi. Pepsi has a negative growth rate, unfortunately, over the last 5 years for their cash flow. In 2018, they had free cash flow of $6 billion. In 2022, they had free cash flow of $5.6 billion. So that comes out to a negative compounded annual growth rate of 1.79%. Weighted average cost of capital was similar to Coca-Cola's. They had a 3.17% weighted average weighted average cost of capital. We can see that 81% of their balance sheet is made up of debt. Similar to Coca-Cola, most of their business is financed by debt compared to equity. They had 2.6% interest rate, 16% effective tax rate, and based on these metrics, it comes out to a 3.17% metric for WACC. They have $37 billion of debt on their balance sheet and 1.3 billion shares outstanding. Puts their intrinsic value per share at $31 per share, which means that they are also definitely not trading below intrinsic value per share. Pepsi would be trading at a much worse share price compared to their intrinsic value in comparison to Coca-Cola based on these metrics right here. Then lastly, we can see for Keurig Dr. Pepper, growth rate over the last 5 years for their cash flows was 11%. We can see free cash flow in 2018 was $1.4 billion, $2.4 billion in 2022. So compounded annual growth rate over the last 5 years was $11.6 billion. Weighted average cost of capital was higher for Keurig Dr. Pepper in comparison to Coca-Cola and Pepsi. We can see that the thing that's different about KDP compared to Coca-Cola and Pepsi is that their business is made up of basically 50-50 of debt and equity, whereas with the other two companies were mainly debt. We can see they have an effective tax rate of 22% and cost of debt of 6% interest rate, so definitely a lot higher than the 2% to 3% interest rate for Coca-Cola and Pepsi. And so that means that their WACC comes out to 6.14%. They have a net debt position of $14 billion and 1.4 billion shares outstanding, putting their intrinsic value per share at $29 per share, which means compared to the other companies, KDP is the one that is trading closest to intrinsic value per share. But unfortunately, like the other two companies, they are not trading below intrinsic value per share based on these metrics. Now we can see a competitor analysis comparing each company to one another based on their financial ratios. We can see that the gross profit margin, net profit margin, and return on assets all go to Coca-Cola. They have the highest out of the three companies, as we can see right here, pretty much doubling the net profit margin of Pepsi and KDP with their 22% net profit margin. Return on equity was highest for Pepsi and Coca-Cola. It was by far the lowest for KDP with only a 5.7% with only a 5.7% return on equity. But remember that Coca-Cola and Pepsi are much more leveraged than KDP. Their balance sheet was mainly debt, whereas KDP's was about 50-50 debt and equity. So that's obviously going to inflate these metrics here. We can see that for PE ratio, Pepsi is trading at the most expensive price at 31 times earnings. Coca-Cola is the cheapest at 24 times earnings. And then all three of these companies are obviously known as dividend-paying stocks. You invest in these companies for the dividend. And we can see across the three companies, Coca-Cola pays the highest dividend yield at 2.77%. So for every $100 you invest into Coca-Cola, you're getting paid $2.77 per year. So based on this, it looks like you'd probably want to give it to Coca-Cola, mainly because they have the best profit margins and they also pay the highest dividend. So yeah, based on this competitor analysis, you'd probably want to give it to Coca-Cola if you're just looking at the financial ratios and the dividend yield. Lastly, I wanted to compare these three companies to past companies that we've looked at. None of the companies were trading below intrinsic value per share, so it's not good enough to get them onto the table here. Occidental Petroleum, ExxonMobil, AMD, ConocoPhillips, Chevron, Google, Alibaba, Albertsons, Etsy, and Apple are the only companies we've looked at so far that were trading below intrinsic value per share. We can see that based on growth rate, KDP had the highest growth rate of the three companies, and it was the only company that had a growth rate good enough to get them onto the top 10 list for all of the companies we've looked at in all of our videos so far. AMD has the highest at 83% over the last 5 years. We can see that for profitability, Coca-Cola had the best profit margins out of the three companies. Their profit margins were good enough to get them onto both tables. 57% gross profit, Adobe had the highest at 86%, and then 22% net profit, Occidental Petroleum had the highest at 36%. For dividend yield, all three companies are competitive in dividend yield. Coca-Cola had the highest with 2.77%, comes in 6th place. Pepsi comes in 7th place with 2.5%, and KDP comes in 10th place at 2.17%. Intel had the highest at 5.52%. And then for second quarter year-over-year revenue and earnings growth, none of the three companies had a revenue growth that beat 11% for Meta. Coca-Cola and KDP had 6% year-over-year revenue growth, and Pepsi had 10%, which is not good enough to get them onto that table. Nvidia had the highest at 101% year-over-year second quarter revenue growth. And then for second quarter year-over-year earnings growth, we can see that KDP and Pepsi were both good enough to make it onto the table, but Coca-Cola was not good enough because they had earnings growth of only 34%, which is worse than the 10th place spot. Nvidia had the highest second quarter year-over-year earnings growth at 843% across all of the companies we've looked at. Lastly, for stock performance over the last 5 years, we can see that KDP returned 44%, PepsiCo returned 60%, and Coca-Cola returned 31%. None of those returns for stock performance are good enough to get them onto this table. Tesla had the highest out of any company we've seen so far with a 1,144% return. So based on this, comparing them to the other companies we've looked at, they're obviously very competitive in terms of year-over-year earnings growth and also very much so in dividend yield. But across the other tables, we can see they weren't good enough to get onto the revenue growth or stock performance tables. Coca-Cola was the only one good enough to get onto the profitability tables. KDP was the only one good enough to get onto the growth rate table, and none of them were trading below intrinsic value per share. If you wanted to compare the companies against each other, you'd probably want to give it to Coca-Cola because they have the best financial ratios and profitability, and they also pay the highest dividend yield. So let me know in the comment section down below what you guys think of these three companies. They are all very competitive with one another. They all pay a very attractive dividend yield. But in comparison to the rest of the market, it's tough to tell if they would actually be worthwhile investments, just because, as we saw, they haven't really returned that much more than the rest of the market, the S&P 500 on average. So leave a like on this video, subscribe to the channel, and I'll see everyone in the next one.